Hello everyone. I'm glad to be here discussing about our project of financial management in which I will be talking about techniques of capital budgeting. I'd like to quickly introduce myself. I'm Anshu Kanjani from BBA Honors M3. Let's get started. Techniques of capital budgeting. Capital budgeting techniques are the methods to evaluate an investment proposal in order to help the company decide upon the desirability of such a proposal. These techniques are categorized into two heads: traditional methods and discounted cash flow methods. I'd like to hand over the further discussion to my classmate Jaideep for traditional methods.
My name is Jaideep Sridhar Jadeja and my topic is traditional method. Traditional method is the desirability of investment project based on its useful life and expend return. Further, this method do not take into account the concept of time value money. Now I will further hand over to Abdul.
Hello everyone, my name is Abdul Bach and I am going to explain the payback period method. Payback period refers to the number of years it takes to recover the initial cost of an investment. Therefore, it is a measure of liquidity for a firm. Thus, if an entity has liquidity issue, in such a case, shorter projects payback period better it is for the firm. Methods of calculating payback period. If cash inflow is constant over the years, then initial cash flow after. And second, if cash flow inflows are changing over the period of time by table method. Now, I will hand over to Sanya to explain the advantage and disadvantage of payback period method.
Hello everyone. Now I will explain the advantages of payback period method. So it is very simple to use and easy to understand. It has a very quick solution to the problem and it gives the preference to liquidity. It is also useful in the case of uncertainty. The limitations of payback period method are it ignores the time value of money and not all the cash flows are recovered from it. It is not realistic and it also ignores the profitability and it also ignores the project's return on investment. Now I will hand over to Aryan to explain the accounting rate of return.
Myself Aryan Usdadia. My topic is account rate of return ARR. Under ARR method, the profitability of an investment proposal can be determined by dividing average income after taxes by average investment, which is average book value after depreciation. Formula of ARR is equal to average of profit after tax upon average of book value of investment into 100. Based on this method, a company can select those projects that are ARR higher than the minimum rate established by the company, and it can reject the projects having ARR less than expected rate of return. Further, I will hand over this presentation to Dev Lakhani.
So I will talk about the advantages and disadvantages of accounting rate of return method. First of all, accounting rate of return is simple and straightforward to compute. Second, it focuses on accounting net operating income. Creditors and investors use accounting net operating income to evaluate the performance of management. And the disadvantages are for every business. If an investment quickly generates cash inflow, the company can invest in other profitable projects. But accounting rate of return method focuses on accounting net operating income rather than cash inflow. The accounting rate of return does not remain a constant over useful life for many projects. A project may therefore look desirable in one period but look undesirable in another period. So I will request Manav to continue the presentation.
Myself Manu Gadia. Now I will explain about discount cash flow method. As method above traditional method do not take into the account time value of money. Rather, this method take into consideration present and future flow of income. However, the discount cash flow method accounts for the concept that a rupee earned today is worth more than a rupee earned tomorrow. This means that the DCF method take into account both profitability and time value of money. Thank you. Rather, I will hand over to Iswa.
Hello everyone, my name is Ishwa Kalola and I would be discussing about the net present value method. The net present value method is the difference between the present value of cash inflow of the project and the initial cost of the project. As per the technique, the project whose NPV is positive or above zero should be selected. If the project's NPV is less than zero or negative, the same must be rejected. Further, if there is more than one project with the then project with the positive NPV or the highest NPV should be selected. The formula of NPV is net present value is equal to present value of cash inflow minus present value of cash outflow. Now I would like to discuss advantages and disadvantages of net present value. The main advantages of NPV is it considers the time value of money, and it is the most simple way to determine the true value of project. It also considers the company's cost of capital. And disadvantages of NPV are it is not accurate method because it depends on the quality of the inputs, and may omit the hidden costs such as opportunity cost and organizational cost. In conclusion of the advantages and disadvantages of NPV, that bring us to the end of the discussion of our topic, techniques of capital budgeting. That concludes that the focus of discussion today. We sincerely appreciate that we had this opportunity to make the presentation for financial management. Thank you.